Okay, let's get started. So far, we've run through two of the four pieces of macroeconomics, through growth economics and depression economics. There are two big pieces left, inflation economics and government budget economics, debt and deficit economics. Today we get to start on inflation economics. Have a nice vacation. Have a nice week away. Problem set 7 will be out tomorrow via the internet and will be due on March 31st at 11 a.m. here in lecture. And we're going to be working now toward midterm 2, which means that we're going to be trying to pick up some of the threads of growth economics in addition to adding inflation economics, because we moved growth economics off of the first midterm and onto the second. So I hope you all remember this question that is going to be on the second midterm so that you will be able to answer it correctly. About how much bigger is total world GDP now than it was 10,000 years ago? And once again, these numbers are essentially guesses. There are enormous measurement problems in even thinking about how one might calculate the change in global real GDP over 10,000 years, or what such a thing might mean. And yes, we're at 92% still remember it. Good. 17,000 is the thing to have in your mind for this. Human populations are now, I'm going to have to stop saying there's 6 billion and start saying there's 7 billion. Human populations are 7 billion, about 1,200 times bigger than they were 10,000 years ago. And as best as we can figure out, average standards of material standards of living are something like 14 times as high. Doesn't mean we're 14 times happier, but still we're producing on a world scale a lot more stuff than we were back 10,000 years ago per capita. And we're doing so even though, and here's another number I should change. I used to say even though 2 billion people live lives that are not significantly distinguishable from those of our pre-industrial subsistence agriculture ancestors, I now have to lower that to 1.5 billion people still around the world live lives that are not significantly distinguishable from those of our pre-industrial subsistence agriculture ancestors. The other thing I want you to be sure to remember, and I'm sure to put on the exam, although this number will actually be different come the second exam on April 7th than it is right now, because we're going to get another employment report out on April 1st, I believe, on Friday, April 1st. I think that's the release date. I think they don't delay it to the 8th. But what is the current unemployment rate that we got? And yes, the current unemployment rate in the United States is 8.9%. That's seasonally adjusted. Actually, 9.5% of those interviewed by the Bureau of Labor Statistics in the second week of February said that of those who said they were either at work or actively looking for work, of those who said they were in the labor force, fully 9.5 said that they were looking for work and had no job %. But the Bureau of Labor Statistics calculates that for the March unemployment release, unemployment is on average 0.6 percentage points higher than in an average month, because February is a slack month. Businesses are still recovering from the Christmas rush. Construction in the Northeast and the Midwest is still at an extraordinary seasonal low, etc., etc. And one thing to note about the fact that the unemployment rate kissed 10% at the end of 2009, and since then has declined back down to 8.9%. You might think that that's good news, right? The unemployment rate rose steeply throughout late 2008 and 2009 from its normal level of 5% or so. It crossed 7.5% at the start of 2009. It headed all the way up to 9.5%. slowly advanced to 10%, kissed 10%, and then came back down. The problem is that the unemployment rate has not fallen because the share of American adults with jobs has increased over the past year and a bit. The share of American adults with jobs today at 58.4% is actually less than the 58.5% of Americans who had jobs seasonally adjusted in late 2009 when the unemployment rate kissed 10%. What's happening? If people aren't getting more jobs, if a greater fraction of people aren't getting jobs, why is it that the unemployment rate's been going down? And the answer is the unemployment rate's been going down because people have been dropping out of the labor force. That a bunch of people who a year and a bit or so would say, yes, I'm looking for a job. They say, I've given up. I'm no longer looking for a job. Now, this doesn't necessarily mean that they have become completely useless people who spend all days watching, say, reality TV auction shows or playing World of Warcraft 24/7. Most of them are probably doing other things, but most of them are probably doing other things that they value less than having a job and earning the money. And so if you think as I do, that the employment to population ratio is probably a better guide to the health of the labor market and to the extent to which the American economy is working up to its economic potential, we haven't seen any improvement over the past 15-odd months. The labor market's still as bad now as it was back then. Which is, I must say, quite distressing to me, both as a citizen of the world, because the world labor market's much the same as an American, and also as an economist. Because we economists really do believe that markets are very flexible and adaptive institutions that recover to shocks, and that if something goes wrong with the market system, odds are it will fix itself gradually over time. It might well fix itself a lot more slowly than you would wish it to fix itself. You might well want to have the government take all kinds of actions to help fix it, in addition to helping it fix itself. But the idea is that a period of extraordinarily high unemployment, of lots of people who want jobs and could do jobs not having jobs, is going to fix itself, even if not as fast as we would like, through the normal market processes of people who have jobs, finding workers who want jobs and hiring them. The fact that that hasn't been happening over the past 15 months is quite distressing, and cause perhaps for some rethinking of economic theory. And another thing that I hope you'll have in the front of your minds when the second midterm comes around, this old question that I put up here because I was talking about it to the graduate students yesterday, of why is Jean-Baptiste Say original insight? That is, that nobody makes anything unless they intend to use it themselves or sell it, and nobody sells anything unless they intend to buy, so that by definition, by metaphysical necessity, total planned sales must be equal to total planned purchases, that there can be no such thing as everyone having plans that add up to a deficiency of aggregate demand. And yes, everyone's still gotten this, because people spend their incomes not just on currently produced goods and services, but on financial assets. And you can have deficient demand for currently produced goods and services and labor if you have excess demand for financial assets, which is what we had in 2008 and 2009. And the last kind of review question I want to ask today through the iClicker is to send you back to our magic equation for the long-run growth model, in which we say that output per worker in an economy is going to be equal to its savings rate divided by the sum of these three terms that are its savings requirements, all raised to this diminishing return power, and then times the efficiency of labor. Suppose that the efficiency of labor is 25,000 per year, etc., etc. What then is output per worker going to be in this economy? And people are actually answering this a bunch faster than I thought you would, which is, I think, a good sign, or I hope it's a good sign. Yeah. Okay. So in this economy, we're going to have a capital output ratio of 3. Savings rate of 21 divided by investment requirements of 7%. And then with a diminishing returns to scale parameter of 1/2, you don't square or take the square root of the capital output ratio when you calculate output per worker. It's just linear in output per worker. So you have 3 times the efficiency of labor, which is $25,000 a year. That'll give you $75,000 a year for output per worker. That's what we're looking for. And just to keep your hands in, just to reassure me that you haven't forgotten everything you learned on, or everything you had studied for last week's exam, once again, the income expenditure model. All 4 components of autonomous spending at 8, adding up to 8 trillion. And, a multiplier that's going to be whatever it is, what's the level of output going to be in this economy with these flows of autonomous spending in it and with these coefficients determining the multiplier. What's going to happen? C's right, 12%, or 12 trillion. You have a multiplier of 1.5 by the time you've subtracted off 25% for the net of tax rate, multiplied it by the marginal propensity to consume, and taken account of the fact that if income falls, a bunch of the income shows up in reduced imports. That gives you a multiplier of 1.5. 1.5 times 8 trillion is 12. That seems to be harder than that seems to be significantly easier than the long-run growth calculations. So I'm not sure why you're not doing as well on them. Let's explore more deeply. We sit with our kind of investment savings version of the income expenditure model. This thing that we owe to British economist John Hicks, parceling out the determinants of total spending and of total output and total demand easily into fiscal policy parts and monetary policy parts. And our machine's going totally haywire. Totally haywire. Hopefully all the people who are saying 1 are wrong. Because the right answer for the multiplier for this is 2. And I'm going to actually save this record and go back into it and see if what we're getting isn't a lot of leakage from the people in the Changshen auditorium next door, in which case we should then reach an agreement about who's going to use which frequency with this iClicker device. And then if you have your multiplier of 2, well, what happens in this economy if a bunch of things in the Federal Reserve and financial markets together raise the long-term real risky interest rate by 3 percentage points? With a multiplier of 2 and with these particular parameters, what's going to happen to output Y? And, yep. Okay, and the answer is, with these parameter values, output is going to fall by 1.8 trillion a year. You're going to get investment spending falling by 750 billion, 25 times 3. And you're going to get export spending falling by 150 billion. Those add up to 900 billion fall in autonomous spending, multiply it by a multiplier of 2, and you get a 1.8 trillion fall in real GDP. That's what the impact of something that raises interest rates is going to be on this economy. And let me run over what we did last Tuesday, since we just did it, then finally move on to the main meat of this lecture, That is inflation economics. And here we have the consumer price index for all urban consumers, for all items in the United States of America since 1950. And the thing to notice, first thing to notice, is that it's 10 times as high as it was in 1950. That over the past 2 generations, according to the Bureau of Labor Statistics, if you had $1 in 1950, you could have bought about 10 times as much stuff with it as you can with $1 today. That the purchasing power of $1 has dropped by about 90 cents. It's simply worth a tenth of what it was 60 years ago. And you can argue over whether this is the right measure or not. There are lots of things that we consume and that we like to consume and that we spend our time doing that are, to a first approximation, absolutely free, that we have available now that we didn't have in 1950. In 1950, the number of people who could watch television was in the hundreds, as opposed to America now, which may, over the next few years, exceed 1 television per person, which would be a remarkable accomplishment. We're already much more than 1 screen per person, but exceeding 1 television per person would be quite remarkable. All kinds of things that people used to pay a huge amount of money for in the 19th century or even in 1950 are available to us for close to free through either broadcast media or the internet. That you might say that in 1950 it was considered a really big deal to have a high-fidelity radio in your house. Back in 1890, you had a New England kind of utopian, Edward Bellamy, writing a book called, Edward Bellamy, writing a book, which name I'm blanking on at the moment, one of the 5 best-selling novels of the late 19th century, which is an absolutely execrable novel, this thing he wrote, Looking Backward. It is the worst novel you can possibly imagine. Complete cardboard characters, no interesting plot, completely unconvincing romantic subplot. He steps out of his authorial role to preach at you all the while. No possible reason for everyone to read it, except a huge number of people in America did, because it excited them about the future, and it looked forward to all the marvels of the future that people living in the 1890s could expect. And of them, the biggest, as his protagonist is transferred forward to the mysterious world of 2100 by an incredible plot device, and then wanders around. Of them, the most extraordinary thing that he learns is that the house he's staying in 2100 has a telephone. And not only a telephone, but a speakerphone. And not only a speakerphone, but you can call up an orchestra that's playing in the city at that moment and put it on the speakerphone so you can listen to music. And not just listen to any music, but there are 4 different orchestras that you could call up. And so you could choose to listen to one of 4 orchestras. And Edward Bellamy's protagonist, at being confronted with this, says that as a result of this, the summit of human felicity has been attained. Which makes me think that he must have had a very low idea of what the summit of human felicity might be, if you can if tuning into any one of 4 effective radio stations is one of them. All those changes aren't in the consumer price index because you can't count them. For the consumer price index, what you can do is you can count by how much have the prices of the things that people bought last year changed between last year and this year, and you can weight those relative price changes by the share of spending last year that went into the various baskets of goods and services that people produced. That's what the Consumer Price Index does. Each year it says how much more expensive than it was last year is our representative basket of goods and services. And as new goods and services are invented, it adds them to the basket gradually over a course of time. They do the best job that they can. Economists believe that the Consumer Price Index, by and large, understates how fast we're growing rich, that it overstates the actual cost of living. We squabble over whether the current overstatement in the Consumer Price Index is something like 0.5 percentage point per year or something larger by 1.5 or 2 percentage points per year. But even if it were 2 percentage points per year, even if over the past 60 years the Consumer Price Index has overstated the rate at which the average price has risen by 2% per year, well, take 0.02, multiply it by 60, and you get 1.2. Take the base of the natural logarithms e and raise it to the 1.2 power, and you have a factor of about 1.5 or so. That means that instead of rising by a factor of 10, the average price in the American economy has risen by about 6 over the past 60 years. This is inflation. And our inflation rate has not been even since 1950. Right here, for example, this 10% or nearly 10% inflation rate. This is the Korean War. How in 1950, dictator Kim Il-sung of North Korea decides it's time to reunify the country and sends his army south. How first the American army and then a United Nations force intervenes in response. How all of a sudden the United States rearms massively to fight first this hot war and then the Cold War, and you have an enormous surge of government demand for goods that are already in short supply. Prices jump by almost 10% in a year. Then the Korean War ebbs and the rate of inflation falls back to its kind of more or less normal 1950s, early 1960s level of 1.5 or 2% per year or so. And then it starts to creep up. It creeps up late in Lyndon Johnson and into Richard Nixon's administration. Then in 1969, 1970, the Federal Reserve decides that inflation is too high and that maybe it should raise unemployment, create a little excess supply on the labor market, create a few more workers looking for jobs who'll say, I know you want paying this guy $8 an hour, but I'll work for $7 an hour. Create a little more excess capacity in the factories so businesses will be a little bit hungrier for business and say, we know that we were going to charge you $20 for this product, but because we have excess capacity and want to sell more, we'll only charge you $19. And so inflation falls, and the Federal Reserve thinks that it's gotten things under control and breathes a sigh of relief. And then the 1973 Arab-Israeli War comes, along with it a global oil embargo from the Middle Eastern oil-producing countries against the United States. The world price of oil triples, and U.S. inflation rises to a peak of 12%. The Federal Reserve hits the economy on the head with a brick again by raising interest rates high. The inflation rate falls back to 5%. The Federal Reserve says the situation's now under control, will return to normal. You have a new normal in the late 1970s, but with an inflation rate now of 6% per year rather than of 2% per year. And so throughout the early Carter administration years, the economists in the Carter administration squabble about what to do with this fact, that inflation, when it was at 1.5 or 2% per year, didn't strike anybody as a problem. At 6% per year, every restaurant has to print new menus every 18 months. Everyone has to change their prices all the time. If you have a memory of what something ought to cost, it's no longer reliable. Question of should the government accept that we have an inflation rate of 6% per year now, or should it do anything? Government's still squabbling about that when the Iranian Revolution happens. when the Shah of Iran falls, when the revolutionary moment that follows is seized by the Ayatollah Khomeini, and when the world price of oil again triples for the second time, and inflation in the United States hits a peak of 14%, at which point newly appointed Federal Reserve Chairman Paul Volcker says enough is enough. Maybe a 6% unemployment rate wasn't something to worry about that much, but a 14% unemployment rate is. And the history of the past 20 years, if it's teaching people everything, it's teaching people that the inflation rate always goes up. We don't want to have a United States that turns out to have a situation in which everyone thinks its money is going to be worthless next year. I need to raise interest rates and so raise unemployment and so stop wage and price increases in their tracks until, once again, everyone's convinced that the inflation rate is going to be low and stable. And the next 3 years have what we economists call the Volcker disinflation. As Paul Volcker does indeed raise interest rates and so hits the economy on the head with a brick and keeps hitting and hitting, the unemployment rate rises to its post-World War II peak of 10.8%. Until Paul Volcker is finally convinced that he's done enough to break the cycle of inflationary expectations, eases off, and then we start our regime since, our post-1984 relatively low inflation regime, in which everyone expects there'll be a little bit of inflation, between 2 and 3% in average years, maybe a bit more in years when something unusual is happening, like Saddam Hussein's invasion of Kuwait that caused another spike in oil prices, until now, when we've had 1 quarter in which consumer prices actually fell. And maybe you can see a downward trend in the inflation rate since the early 1990s, maybe not, but in which the inflation rate is once again relatively low and relatively stable. That's the history of inflation in the United States over the past 60 years. That's what we're going to be talking about between now and the second midterm. And I suppose the first question to ask is, why is this inflation a problem? You know, prices go up, but incomes go up too. Yesterday in the email, I got a link to a post from a Federal Reserve Vice President at the Federal Reserve Bank of St. Louis, David Andolfato, which someone sent me because he rather uniquely, for a Federal Reserve official or a Federal Reserve staffer or a Federal Reserve affiliate, called Congressman Ron Paul a pinhead. And, you know, since the Congress created the Federal Reserve and oversees it, this is not something you usually see. Federal Reserve Vice Presidents usually say the respected senior member of Congress has some questions, which I will strive to answer, rather than the guy will be a real pinhead. But what David is talking about is he's taking a quote from page 25 of Ron Paul's book, End the Fed, in which Ron Paul says the Fed has done an absolutely awful job of maintaining price stability since 1913. That the goods and services you could buy for $1 in 1913 now cost nearly $21. And this is simply the flip side of the consumer price index graph that I showed earlier, projected further back into the past. That the price level in 1950 was 1/10 of what it is today. The price level of 1913 was 1/20 of what it is today. What you could buy in today for what costs today $1, average cost 5 cents back in 1913. And then comes the part that David Andolfato objects to, that the purchasing power of the dollar itself has fallen to less than 5 cents of its 1913 value. We could then say that the government and a banking cartel have together stolen 95 cents of every dollar as they've pursued a relentless inflationary policy. And David Andolfato's critique is that that's only half the story. Yes, on average, prices today are 20 times what they were in 1913 when measured in dollars, but also wages today for the same jobs at the same skill level are much more than 20 times what they were in 1913. That over the 100 years since 1913, real wages have about tripled. So that your real wage today is about 140 times what it was in 1913 for the same jobs. And of this, a factor of 7 is because real wages have risen, and a factor of 20 is because even had real wages not risen, if all prices go up by a factor of 20, all wages will go up by a factor of 22, because every price paid is ultimately paid to somebody as income. That you can't have a situation in which inflation causes prices to go up 20-fold while wages stay the same. That inflation will raise both prices and wages, and will raise them both relatively equally. So what's the big idea? If you have price stability, then your prices stay the same and your wages rise at the rate of real economic growth. If you have inflation, prices rise at the rate of inflation, and wages rise at the rate of inflation plus the rate of real economic growth. How does the fact that we have that our dollar now is really the equivalent of a dime in 1950 or a nickel in 1913 hurt us? Because a dollar is the equivalent of a dime on both sides, both when we're earning money and when we're buying things. It would seem to be a big zero. Now, it's not quite a big zero. That is, inflation is a problem. Even though prices go up and incomes go up too, not all prices and incomes go up evenly. For one thing, if you're holding dollars in your pocket or in a no-interest bank account, inflation is a clear loss to you. Inflation's a clear loss to you because the dollar in your pocket actually buys less. Inflation is thus a sneaky and underhanded way for the government to impose a tax on all of the cash that you have in your wallet. Inflation's also a big redistribution. A redistribution from those who did not expect inflation back when they made their contracts to those who did expect inflation when they made their contracts, and who as a result incorporated inflation allowances or inflation indexation into the bargains that they made. More important, I think, is a loss of information carried by prices, that if the price level is stable, you can kind of go in shopping for a refrigerator after a decade and you kind of know what a refrigerator should cost, so you can figure out whether this is a good deal or not without much effort. If prices are rising by, say, 10% per year, or if prices are rising by an uncertain amount that varies from year to year between 5% and 15%, you go into a store after 10 years to buy a refrigerator and you have no idea what it should cost because all your memories of previous refrigerator shopping are completely inapplicable to the current situation. And this loss of information carried by prices, this is a form of putting sand in the gears of the market mechanism. And it's certainly not a good thing. Although how bad a thing is it, economists argue about over and over again. And most important of all, perhaps, is a redirection of effort and energy to gaming the system. That is, people running businesses and making investments should be focusing on how to make their company's production operations more efficient, and should be focused on which lines of business are likely to produce the highest social returns for more investments. They shouldn't be focusing on what's the rate of inflation going to be, how can I forecast it, and how can I profit from or at least avoid loss from the inflation process. And this redirection of effort and energy away from actually making things better and cheaper and more efficiently to figuring out how to deal with the complexities of the monetary system is probably the biggest loss that comes from an ongoing process of inflation. And once again, we economists argue over how large this loss is and don't really come to conclusions. Alan Greenspan was prone to say that he thought that this cost was fairly significant, that he thought a bunch of relatively slow growth in the 1970s, maybe 0.5% per year or so of reduced long-term economic growth, was due to the high inflation of those years, which meant that this burst of inflation left the United States in 1982 or so 5% poorer than it might otherwise have been. And then there's the question of, was that loss then made up, and is that an accurate estimate? I don't have a view, except it sounds large to me, but that's the way that economists try to think about this particular question. As far as economic policy is concerned, what is certain is that a process of high inflation is a very big negative for politicians in office, because inflation is taken correctly to be a sign of an incompetent government. And so a government that presides over high or even moderate inflation is a government that's likely to lose the next election. And so politicians tend to be quite firmly focused on inflation control, especially after the defeats of Jimmy Carter and James Callahan in the U.S. and Britain at the end of the 1970s. Two opponents, Ronald Reagan and Margaret Thatcher, who promised to control inflation and then did so. So inflation economics. How should we think about the process by which you get inflation, by which consumer prices rise? And the easiest way to think about it, and a pretty accurate way, is simply to go to the quantity theory of money. To say that we all have money, we all hold money in our pockets, in our bank accounts, in the unspent balances on our credit cards. And we all hold money for one particular reason, to spend it. That if you don't want to spend it, there are other better things to hold your money in, to hold your wealth in, than cash money. If you're not going to spend a piece of your purchasing power over the next 5 years, much better to hold it in a 5-year treasury bond or a 5-year treasury indexed security than to hold it in the form of cash. The 5-year treasury indexed bond is certainly a safer thing. The U.S. government's still going to be there after 5 years. Hold your money in a 5-year tip, and after 5 years at current interest rates, it's grown by 10%. Hold it in cash in your pocket for 5 years, and after 5 years, you just got what you did. Money is clearly dominated as an asset if you're holding it for any purpose other than spending it. And so, economist Irving Fisher a century and more ago said, money has a velocity, for which we use the letter V. And the velocity V of money is the pace at which people are used to spending the money in their pockets. And V will go up or down. V tends to go up when interest rates rise. V tends to go down when interest rates fall. V changes as the banking technology of the economy changes. V is larger if more spending is done by the government, et cetera, et cetera. But you take the total amount of money in the economy, you divide it by the price level P, you multiply it by the velocity of money V, and then you're going to get the level of real spending in the economy, Y. What we've seen over the past 4 weeks, you get out of the income expenditure model, out of summing up consumption spending, investment spending, government purchases, and net exports. You can also get by going through the quantity of money and saying that total real spending is also equal to the real quantity of money, the nominal quantity of money divided by the price level, times the velocity of money. And Chapter 11 of the textbook that Marty Olney and I wrote is all about how that works, how it comes to pass that you can get to the level of real spending both through the income expenditure model and through this quantity theory of money. I won't go into that in any more depth here, But the useful thing about the quantity of money, the useful thing about the quantity theory of money, is that it actually puts the price level into the equation. And so you can take your quantity theory of money, you can assume that the economy is not going to be that far away from its productive potential, that after all, if the economy can't produce more than its productive potential, and if the economy is producing a lot less, you shouldn't be worrying about inflation economics, you should be worrying about depression economics. So say we have an economy that's pretty close to full employment. And then what we're going to have is we're going to have that, the full employment level of the economy is equal to M over P times V. And we can turn that around to get an equation for what the price level is. That the price level in the economy is going to be equal to its money stock times the velocity of money, divided by the level of production, which will be close to the economy's productive potential. And so when something boosts either the velocity V or the money stock M, right, the price level is going to go up. Want to keep the price level from going up? Well, banking technologies and organizations will change only slowly, so V will not change very fast. Want to keep the price level V from going up? Well, keep the money stock M from going up. And that was Milton Friedman's central career insight, that when something boosts, what boosts M is going to boost the price level, that inflation is ultimately a monetary phenomenon. But then you've got to figure out how exactly does adding to the stock of money boost the price level. Well, if you'll remember from before, what happens when the central bank engages in open market operations, when it buys bonds for cash, that pushed down the interest rate on bonds, and that tended to make investment and exports grow, and that tended to push up the level of demand in the economy. So there's a link going back through the Depression economics unit from how it is that the money stock affects spending. And then there's a link for how it is that spending and production relative to the economy's productive potential then influence the price level. And in order to look at that link, what we'd really like to have would be a nice measure of the gap between the economy's current level of production, Y, and its potential level of production, Y star, its potential output. And we're lucky in that such a link is given to us by the fact that we measure the unemployment rate. So let's go back to what we covered before, what we called Okun's law. The relationship between changes in real GDP along the horizontal axis and changes in the unemployment rate along the vertical axis. A relationship that's broken down somewhat over the past 2 years. Right? Here's the 4 quarters ending in 2000 and the second quarter of 2009, when it really did start to break down. But that otherwise is quite a good and robust statistical relationship. That by and large, when the level of production in the economy is growing faster than potential output, unemployment will fall. When the level of production is falling or growing more slowly than potential output, unemployment will rise. So the Federal Reserve, by changing its interest rates and changing the rate at which the money supply is growing, can affect the level of production relative potential or affect the unemployment rate, which is much the same thing. And so we're going to focus for most of the next 2 weeks, or not 2 weeks, 3 weeks, because we're not going to be here for the first of them. We're going to focus for the next 2 weeks in classes on the relationship between the unemployment rate and the change in the price level, the rate of inflation. If you've got to actually do calculations with Okun's law, these are the numbers to remember. That is, by and large, take the change in output as a percentage, take the change in output relative to the current level of output, subtract off N, the population growth rate, subtract off G, the rate of growth of the efficiency of labor, take all that and multiply it by 0.5. Oh dear. And we need to add a minus sign to that. So let's add a minus sign to that one and that one. Because when output is growing faster than normal or than potential, unemployment falls, and when output's growing slower than normal, unemployment rises. That's how you calculate the likely change in the unemployment rate that's going to be accomplished by faster or slower growth than potential. Integrate this and substitute in the level of potential output, and you get your nice rule of thumb for what the unemployment rate is at any moment in time in its level. Take 1, subtract from 1 the level of output divided by potential output, multiply that difference by a half, and what you then get is the unemployment rate minus what Milton Friedman called the natural rate of unemployment. The rate of unemployment at which the economy is in balance, at which there's neither upward nor downward pressure on inflation, at which the economy is producing at its sustainable, stable price or stable inflation rate productive potential. Those are the things to hold in mind. And so let's go to our iClickers. Right? Suppose that our natural rate of unemployment is 5%. Suppose our output's 14 trillion. Suppose potential output is 15 trillion. What then is unemployment U going to be? What then is unemployment U going to be if we have this third equation back down here, this lowest equation in this algebraic formulation of Okun's law? So what we got is we've got 5% for the natural rate of unemployment, 14 trillion for output, and 15 trillion, for potential output. Okay. And at least what I hope we're going to get, I hope we're going to get is, yes, we have a good plurality at the right answer at 6.3%. That is, you should have divided 14 by 15 and got about 0.06, right? 0.067. You should have then subtracted that from 1. You should have multiplied that by 2. And you should have gotten... No, actually, that's not right. Let's go back. Bingo. 0.5 times 1 minus 14 over 15. 9 over 10, well, 1/15th, 1/10th is 0.1. 1/15th is 0.0667. 14/15ths is thus 0.93. 333. 1 minus 0.93333, that's 0.06666. Multiply that by 1/2, and you get 0.0333. Add 0.0333 to the natural rate of 5, and you should have gotten B. We should have gotten B. And once again, this is hard, but this also is going to be on the second midterm. This also is worth learning. So once we have our unemployment rate and our use of Okun's law, so we can then go back to our income expenditure model and figure out how fiscal policy, monetary policy, and the economic environment have together produced the level of real GDP in the economy. And then we've compared that to the level of potential output and have gotten an expression for what the unemployment rate's likely to be. How then do we go from the unemployment rate to the level of inflation? And so we write down another equation. We write this little pi for inflation. Why pi? Because we wrote P for the price level. Pi is kind of related to P. It sounds the same. It's the same letter in Greek as in P as in Latin. And so the proportional rate of change of the price level is going to be the inflation rate, pi. We're going to write E of pi, expectation of pi, for what the expected inflation rate that people in the market generally have. We write U for the unemployment rate. We write U star for the natural rate of unemployment, or the non-accelerating inflation rate of unemployment. We take all these variables and we write them down in this equation here. That the inflation rate this year is going to be what people expected the inflation rate to be last year when they formed their expectations and their plans, plus this parameter beta or B times the difference between the natural rate of unemployment and the actual rate of unemployment. How do we think about this equation? Well, we think about it this way. We think that people last year made their plans about what they were going to ask for in terms of wages and charge in terms of prices, in terms of what the price level was last year and what they thought the inflation rate between last year and this year is going to be. And then this year rolls around. And either the unemployment rate is higher than the natural rate of unemployment or lower. Either capacity utilization is lower than its normal value or higher. If the unemployment rate is higher than its natural rate, and if capacity utilization is lower, workers say, oh wow, there are lots of unemployed workers out there who might compete with my job, for my job. Maybe I shouldn't ask for wage increases as high as I had planned on. Maybe I should go to the bosses and say, we'll accept a 2% lower wage increase this year because we understand that we can be replaced. And we also understand that business is slow because high unemployment goes with low capacity utilization. So whenever capacity utilization is low and unemployment is high, actual inflation is going to undershoot expected inflation. Conversely, whenever the unemployment rate is low and capacity utilization is high, actual inflation is going to overshoot expected inflation. And there are other things that you could throw into this equation as well. Most prominently in 1973 and 1979, the triplings of world oil prices had a direct effect boosting inflation, even though they didn't act directly on either expectations or on the rate of unemployment. How well does this do? Well, most of the time, expectations of inflation are static. That is, people just take a look at what the current rate of inflation is, and they say inflation next year is probably going to be about the same as inflation this year. This means that people will adapt over time. If inflation goes up, if inflation this year is higher than inflation was last year, then people looking forward 2 years from now aren't probably not going to expect that inflation will return to its old value. If inflation rises, that rise will get incorporated into expectations in an adaptive way. But by and large, if you want to forecast what inflation expectations in the economy are this year, you won't do badly by simply saying people expect this year inflation to be the same as it was last year. That's a pretty good rule of thumb for the United States, but not a good rule of thumb for places where inflation is doing something weird or getting out of control, like, say, Zimbabwe in the late 2000s. So if that's the case, you can then look at the change in inflation rate and say that the change in the inflation rate, that is the difference. That the change in the inflation rate, that tells you the difference between inflation and expected inflation. That taking the inflation rate pi and subtracting off the expected value of pi, well, that will be close enough to the change in the inflation rate. And you can say that the unemployment rate, well, we know what the unemployment rate is, and we can plot a graph of what happens when the inflation rate changes, or what happens to the inflation rate, to the change in the inflation rate at different levels of the unemployment rate. And this is the graph that we get. Not the tightest fit in the world. Some really weirdo things, like here, the Iranian oil crisis of 1979. Some kind of interesting times like right now when the inflation rate isn't slowing or is slowing only slowly, even though the unemployment rate is quite high. But still, by and large, on average, over the course of the past 60 years, or no, this is only 50 years, over the course of the past 50 years, whenever the unemployment rate's bigger than 6.5%, you can bet that the inflation rate's going to fall. Whenever the unemployment rate is less than 5%, you can bet that the inflation rate is going to rise. In between 5 and 6.5% or so, between 5 and 6.5% or so, it's unclear whether inflation's more likely to rise and fall. That is, our uncertainty about what the natural rate of unemployment that corresponds to an economy in balance is really is that great, and the natural rate of unemployment does shift around by about that much from decade to decade, although not from year to year, as the demography of the labor force changes and as the workings and educational level of the labor force and as the job requirements of the economy kind of change. But this is a relationship that you can take to the bank, not in 6 months, not in 1 year, but over a 5-year period, say. That if the unemployment rate is going to be more than 6.5% and stay there, then you can bet that inflation in 5 years is going to be lower than it is today. If the unemployment rate is going to be 5.5% or lower over the next 5 years, you can bet that inflation 5 years from now is going to be bigger than it is today. That's the Phillips curve, and we're going to be using the Phillips curve a bunch on problem set 7 to kind of figure out what the relationship between unemployment and inflation is. It's a nice little handy conceptual tool to scribble down. What you do is you figure out what the slope of the Phillips curve is, what this beta parameter in the Phillips curve is that relates the change in inflation to the change in unemployment. And you also figure out what the level of expected inflation is, which I've written here with a pi star simply because I prepared this slide too late on Tuesday night. It should be an e pi. I'll change that. And this u star for the natural rate of unemployment. The Phillips curve is going to go through the point at which inflation is equal to expected inflation and unemployment's equal to its natural rate. You might as well think of those as the definitions of expected inflation and the natural rate. Yeah?
So from where do we derive the beta?
I'll give it to you. There's no easy way to derive it. And attempts by economists to figure out what beta should be are extremely hazardous and by and large unsuccessful. A study by Robert Lucas in the 1980s relating beta to the volatility of inflation was just named one of the 20 best economics papers written in the 20th century by a panel of the American Economic Association. And the rule of thumb he derived was that the more volatile inflation is, the steeper the Phillips curve will be. So that a situation in which inflation hasn't been very volatile for a long time will see a pretty flat Phillips curve. While if, say, the country is next to undergoing a hyperinflation, the Phillips curve is going to be very, very steep indeed. But we have no good derivation from microeconomic foundations or from behavioral foundations of what it is. Instead, what we have is we essentially have this scatter. And our belief that this scatter is good enough and reliable enough that we'll make forecasts from it for the future, even though there's no good reason to think that we have a good, sound, quantitative definition of why this scatter simply happens to be. Okay, so the Phillips curve. It has a slope that I'm going to have to give to you on problems. It goes through the point where expected inflation, where kind of inflation is equal to expected inflation, and the unemployment rate is equal to the natural rate of unemployment. Then if production is below potential, And if the unemployment rate is higher than the natural rate of unemployment, then inflation will be lower than its expected value. High rates of unemployment relative to the natural rate produce low levels of inflation relative to the expected rate. If expected inflation rises, if all of a sudden something happens that makes people think that inflation will be higher than they'd thought before, like, for example, ex-president, the late François Mitterrand of France, who ran for the presidency of France at the start of the 1980s on a socialist ticket, saying it's time to get France back to work again, to reduce unemployment, and if there's a little extra inflation, I don't really care. Well, Mitterrand's campaign convinced everyone that inflation was going to rise, so expected inflation went up. And so even without any change in unemployment, even without any reduction in unemployment below its natural rate, France saw a burst of inflation starting even before Mitterrand's inauguration and continuing through his first couple of years in office. If expected inflation rises, that's going to move the whole short-term Phillips curve up in this particular way. If expected inflation falls, similarly, that's going to move this whole short-term Phillips curve down. And I think there was one more. If production is above potential output, if the unemployment rate is lower than the natural rate, then you can bet that inflation is going to be above its expected value. That's the simple graphical analytics of the Phillips curve. So let's go back. Let's go back to your iClickers. Let's write down the Phillips curve equation, the bottom one here, and actually ask, if the natural rate of unemployment is 5%, if expected inflation is 4% per year, if our parameter beta is 1/2, and the actual unemployment rate is 8%, then what's the inflation rate going to be in this economy? What is the fact that the unemployment rate is so high above the natural rate of unemployment going to do to an economy where expected inflation is 4% per year? Okay. All right, and now let's figure this out. Right, that the actual unemployment rate's 8%. That means that the actual unemployment rate's 3 percentage points higher than the natural rate of unemployment. With an actual inflation or unemployment rate 3% higher, we have a -3 for these terms here. Multiply it by our beta coefficient of 0.5, and we get a 1.5. So we're going to be subtracting 1.5 from the expected rate of inflation. The expected rate of inflation is 4% per year, so that should give us an answer D of 2.5%. What went wrong? What went wrong with the majority answer is that when the actual unemployment rate is high, inflation is going to be lower than its expected value. That the Phillips curve slopes down and not up. That high unemployment goes with low inflation. Low unemployment goes with high inflation, not the reverse. The people doing C got that wrong. Let's try it again. The natural rate of unemployment is 5% and 2% expected inflation. A parameter of 1 for the Phillips curve rather than for 1/2. What's the inflation rate going to be for these parameters in this particular economy? Which looks somewhat like us, except the actual unemployment rate is lower than our current one. Certainly expected inflation in the U.S. economy right now is about 2%. It's not that far different from there. And so once again, let's do it. Actual unemployment is 2 percentage points higher than the natural rate, so that's a -2. Slope of Phillips curve of 1, so you still have a -2. Expected inflation is 2% per year. 2% minus 2 is 0. We should get an answer of B, that the actual inflation rate is going to be 0%. That's what happened to Japan in the 1990s. Right, the actual inflation rate hit 0 and then went a little bit further and stuck. It didn't fall much below zero because this Phillips curve relationship tends to break down in times of deflation, in times when consumer prices are actually falling. And with luck, we'll cover a little bit of that either before or after our kind of second midterm. But say for the United States, during the whole period since World War II, except for this one quarter in 2009, the inflation rate's been positive. And I don't think we really have to worry about deflation. Okay. Now, what determines the location of the Phillips curve? I already talked a little bit about this beta parameter that we pull out of thin air based on historical price patterns. Yeah, there we are. I talked a little bit about expected inflation and said it's usually fairly closely linked to what happened last year. But there are times when inflation expectations are what the Federal Reserve calls well anchored. That is, when just because inflation is high or low this year doesn't mean people are going to change their expectations of inflation because they have confidence the Federal Reserve is going to have an inflation target and hit it. But the expected rate of inflation, that's largely a matter of expectations. That's something that can shift quickly as people change their minds. The natural rate of unemployment, usually it's going to be stable. Say 5%, 6% in the U.S. today. Sometimes it won't be. There were all these arguments in the 1970s when baby boomers like me were entering the labor force. All these economists saying that people in their 20s, they're really lousy at job search. They don't know how to work the system to find good jobs. They tend to mouth off in front of their bosses and get fired. They also tend to be slackers. And so, as a result, a labor force that has a lot of 20-somethings will have people who won't keep their jobs for very long on average and will have a hard time finding their jobs after they lose them. So that we should expect the natural rate of unemployment in an economy to be higher when a baby boom generation is in its 20s than when a baby boom generation is like now in its 50s. And that seemed to be proved to be true, that the natural rate of unemployment fluctuates with demography. The natural rate of unemployment is supposed to fall when the labor force becomes more educated. It's going to move itself slowly over time. And there are also the worries about structural unemployment. If the structure of the economy is changing rapidly, so that a bunch of industries are shrinking rapidly and a bunch more are growing rapidly, won't it be the case that those workers who are losing their jobs in the declining industries will have a hard time picking up the skills needed in the expanding industries, and won't that push up the natural rate of unemployment? Answer, probably yes. And if your unemployment rate is high for a long time, as it has been in the United States now, as it's going to be in the United States, isn't it likely that a bunch of people who would normally be counted as unemployed won't really be looking for work, or will have lost so many of their job-related skills, or have lost so much of the ability to actually show up at 9 o'clock 5 days a week that people will be loath to hire them? Doesn't a prolonged period of high unemployment itself raise the natural rate of unemployment? I was reading, good God, I have 2 gigabytes of storage space in my Dropbox. That is genuinely scary. What do I have that's worth 2 gigabytes? I don't know. Well, actually, I think I do know. It's mostly audios of the lecture from this course that I've been moving around. That will take up a bunch of space. I was reading this morning an article by my old teacher, Peter Diamond from MIT. His Nobel Memorial Lecture from last year, a whole bunch of it was about structural unemployment and the extent to which we can expect high unemployment now to show itself in a higher natural rate of unemployment in the U.S. economy in the future. And on topics like this, Peter Diamond is the world's expert. In large part because of that, Larry Summers and Christy Romer persuaded Barack Obama to nominate Peter Diamond to the Federal Reserve Board, but now Senator Shelby from Alabama says he's unqualified, which strikes me as the most pinheaded thing said by a member of Congress in the past 2 weeks, even more pinheaded than David Andolfato's attack on Ron Paul. Peter Diamond's eminently qualified. We have this particular Phillips curve. Here I should put up this graph showing that if you think that actual inflation, or if you think that expected inflation is just what inflation was last year, you can say that the vertical axis on this graph shows the difference between actual inflation and expected inflation. And you do indeed get this downward sloping scatter showing that whenever unemployment's high, actual inflation is going to be lower than expected inflation. Evidence for the existence of a Phillips curve. If you look at the actual history of unemployment and inflation in the United States since 1950 or so, you get an interesting scatter which at first glance looks like a complete and total mess. But if you use the idea of the Phillips curve, and if you think about what expectations of inflation were in the U.S. economy, you can kind of make sense of the actual scatter of unemployment and inflation in the United States over the past 60 years. Let's start in 1949, the last year when there actually was deflation, when consumer prices actually fell because of the late 1940s recession. The unemployment rate was high, and so you'd expect price increase, actual inflation to be less than expected inflation, and indeed prices did fall. Then the Korean War starts. And by 1951, the unemployment rate's down to less than 3.5% because of expansionary expansionary fiscal policy, and our inflation rate's up to 8%. The unemployment rate continues to fall a little bit in the mid-50s, and the inflation rate comes down after this big boom of wartime-related inflation is over. And then in 1954, you have a recession, and you go back to a more normal level. And then from 1955 to 1960, you see the economy performs a loop. As the unemployment rate falls, the inflation rate tends to rise. As the unemployment rate rises, the inflation rate tends to fall. And by the start of the 1960s, you're more or less back to normal. You can look at these loops that the economy did throughout the 1950s and say, yes, there's a relationship between unemployment and inflation. There's a Phillips curve. It's not a terribly tight or a terribly good thing. Lots of other things are going on in the 1950s. But in general, those times when unemployment was high, when those times where inflation was low, those times when unemployment was low were times when inflation was high. Moving forward to the 1960s, it fits a lot better. Say starting right smack here in 60, 61, 62, 63. Things then go along quite fine until you hit 65, 66, 67, 68, 69. Then in 1970, things grow haywire. You could well argue that there was a quite stable Phillips curve in the 1960s, looking a lot like this red line here, that the economy moved along. And then something happened in 1970. That something that happened in 1970 was finally the breaking of inflationary expectations. Remember that the position of the Phillips curve is going to change if either the natural rate of unemployment changes or if expected inflation changes. The natural rate of unemployment wasn't changing much over this time period, and neither was the economy's expectations of inflation until 1970. And then starting in 1970, people begin to expect that not only that there'll be more inflation than there was on average in the 60s, but that inflation's going to keep and start rising. And so starting in 1970, the Phillips curve starts moving all over the place very quickly. And let me stop there, wish you all a good vacation, and say that I'll see you in a week and a half.